Have you ever driven down a brand new highway or walked into a huge, shiny tech park and just thought, man, I wish I could own a piece of this? What if I told you that you could actually earn money every single time a truck pays a toll or a giant company pays its rent? Well, guess what? It's not just for the super rich anymore. Today, we're going to break down REITs and InvITs, two incredible ways for you, the retail investor, to own a real slice of India's growth story.
So here's the game plan. First, we'll start with a super simple way to think about these things. Then we'll dive into REITs and then InvITs. After that, we'll look at all the advantages for you, what the outlook is for 2026, and finally, how you can actually get started. Sound good? Okay, let's jump right in.
All right, first up, let's get our heads around the basic concept. And honestly, the easiest way to do it is to think of these as a mutual fund of things.
You know how a mutual fund works, right? It pools money from tons of people to buy a bunch of different stocks. Well, this is the exact same idea. But instead of stocks, the fund is buying massive physical assets that you could never afford on your own. We're talking about those grade A office buildings, entire shopping malls, major highways, and even power lines. It's a way for all of us to co-own things that generate real, steady income.
Okay, now this number on your screen, 90%, this is the magic number. You have to remember this. SEBI, the market regulator, has a rule that says these trusts must pay out at least 90% of their cash flow back to investors like you. And let me be clear, this isn't a suggestion, it's the law. That's what makes these instruments so powerful for generating a regular, predictable income.
Okay, so you get the basic idea. Now let's get specific and talk about the first type. We'll start with REITs, which is basically your ticket to becoming a micro-landlord without any of the usual headaches.
So a REIT, that's a real estate investment trust, is all about owning high-end commercial properties. Picture one of those massive, swanky IT parks in Bengaluru that houses huge global companies. As a REIT investor, you own a tiny little piece of that park. So when those big-name companies pay their rent every month, a slice of that cash flows right into your pocket. You get the rent, but without any of the calls about a broken air conditioner. It's the best of both worlds.
And the process itself is just beautifully simple. You buy units on the stock market just like you'd buy a share of a company. The REIT takes all that money and goes out and buys these amazing properties. The blue chip companies in those properties pay their rent. And then, boom, thanks to that 90% rule, a big chunk of that rent gets paid out directly to you. It's a really clean, straightforward cycle. All right, so we've talked about buildings. Now let's shift gears and talk about owning the very backbone of our economy. This is where InvITs come in. Think of it as owning the nation's toll booth. So an InvIT, or Infrastructure Investment Trust, owns the things we absolutely need to function every single day. Seriously, think about it. Every time a car or a truck passes through a toll plaza, somebody's earning a fee. Every time electricity gets sent across the country through power lines, somebody's getting paid. With an InvIT, that somebody can be you. You're literally investing in the arteries of the economy. So let's put them side by side, because this really clears things up. REITs are about real estate, offices, malls, and their income comes from rent. This tends to be super stable because they have long leases, 5-10 years sometimes. InvITs, on the other hand, are about infrastructure, roads, power lines, and their income is based on usage. That can vary a bit more, right? If traffic is low one month, income might dip. And that means the risks are different too. For REITs, the big worry is a major tenant leaving. For InvITs, it's more about things like a change in government rules or lower than expected traffic. Okay. So we've defined REITs and InvITs, but let's get to the real bottom line here. Why should you, as a retail investor, actually care about any of this? I mean, what's in it for you and your money?
Well, the benefits are actually pretty huge. First up, that steady income we keep talking about, that 90% payout rule is a game changer. Second, you get true diversification. What affects office rents is totally different from what affects the stock market. Third, they're liquid. Unlike buying a flat, you can sell your units in seconds on the stock exchange. Plus, you have pros managing these massive assets for you. And maybe the best part, it's accessible. You don't need crores. You can get started with just 10 or 15,000 rupees.
And this quote right here, this gets to the heart of that diversification benefit. So what does all that jargon actually mean? It's simple. It means that when the stock market is going crazy and maybe heading down, your REITs and InvITs might be holding steady or even going up. They march to the beat of a different drum. And that acts like a fantastic cushion for your whole portfolio, making the ride a lot less bumpy. Okay, let's bring it all into the here and now. What does the landscape look like for 2026? Because it's shaping up to be a pretty big year for these investments, with some major opportunities, but also some risks to watch out for. So on the plus side, you've got some serious tailwinds, things pushing them forward. New SEBI rules are making it easier for big players like mutual funds to jump in, which is great for everyone. And the government's huge asset monetization plan means there's going to be a flood of new, high-quality infrastructure assets coming to the market through InvITs. But of course, there are headwinds too. These investments can be sensitive to interest rate hikes, and for REITs, there's always the risk that a big tenant might pack up and leave.
And if you need proof of their potential, just look at this snapshot from 2025. The Nifty REITs and InvITs index returned over 25%. That is more than double what the Nifty 50 delivered. Now, of course, past performance is never a guarantee for the future, but wow, that really shows you the kind of momentum we're talking about here.
Now, seeing a number like that, you're probably asking a very smart question. Okay, what's the catch? Are these things totally risk-free? And the honest, simple answer is no. No investment is. It is absolutely crucial to understand the risks involved. First, since they trade like stocks, their prices go up and down every day. That's just market risk. Second, interest rates are a big one. If interest rates in the country go up, these can become a bit less attractive in comparison, and their prices might drop. Then you've got regulatory risk. A change in government policy could affect things. And finally, credit risk. If a huge tenant in a REIT goes bankrupt or leaves, well, that's going to hit the income. Okay, we have covered a ton of ground. So let's wrap this all up and get to the most exciting part. How can you go from just watching this to actually becoming an owner of these amazing assets? The best part is it's probably way easier than you think. It's really just 3 steps. 1, you use the same demat account you use for stocks. No new paperwork. 2, and this is important, do a little homework. Look at the specific trusts out there. What assets do they own? What's their rental yield? Who's the management team? And 3, just start investing. You can put in a lump sum or even set up an SIP, just like you would for a mutual fund.
You know, when you really think about it, this is all about a fundamental shift in your perspective. Every single day, you're a consumer. You use the roads, you work in the office buildings, you use the power. REITs and InvITs give you the chance to flip the switch, to stop being just a consumer of India's growth and start being an owner, earning a real income from the very things that make our country run.